Hi, I'm Mike Cintolo, Chief Analyst of Cabot Growth Investor and Cabot Top 10 Trader, and I'm here with your Cabot Weekly Review, recording this late Friday morning as usual on September 22nd. So the market's been in kind of a 2-month correction with some bad, more bad than good, but some bad, some encouraging stuff, kind of, up and down depending on the week. This week, a little bit of a change in character. The Fed comes out, whatever they said, but the market interpreted it hawkishly. We've had an upside breakout in interest rates and really kind of across the board selling pressure in really everywhere, all the major indexes, the entire broad market and all that. My thoughts on this are pretty straightforward. I mean, we were cautious anyway, but you can argue about next week or next month or whatever. Right now, there's no question the sellers are in control. The intermediate term trend is down for all the indexes. 80% of stocks coming into Friday anyway were below their 50-day moving averages. In fact, I think yesterday had the fewest number of new highs on any day of the NASDAQ this year. Just a sign that there's really just no buyers and a lot of sellers. So right now, I just think you should still be cautious, defensive, whatever you want to call it, honoring your stops, small new buying if you're going to do new buying at all, that sort of thing. The selling pressure, this could be the kickoff of a big down leg, but we'll see. Beyond right now, to me, it's still more of a coin flip, or I'm really not even going there. Like I said, it could be the start of a new down leg. Maybe the interest rates start soaring and it's just way too much for the economy and the market to handle. Certainly possible. Interest rates to me are secondary, but let's face it, it's kind of been the tail that's wagged the dog here for the last year and a half when it comes to the Fed, inflation rates and all that stuff. So, hey, if rates really soar, all bets are off sort of thing. But I'm certainly not ruling out this being, the start of a bad 2 or 3 weeks maybe, but then we kind of come into October where bottoms often happen and we kind of bottom out for this correction here since July and kick off some advance on, who knows, inflation comes in lower than expected. So my message is really right now, I'm not sitting here trumpeting sunshine. Right now, plenty of cash, be defensive. It doesn't really matter. It used to be kind of, well, growth stocks are hit, but cyclicals look okay. Now it's just kind of across the board defensive stocks, income stocks, growth stocks, commodity stock, they're all kind of getting hit. So I would just have cash, be careful, honor your stops, take some partial profits or shave some positions if you have overweight positions, that sort of thing. But then just kind of take it day to day from here. If it's bad and things really go bad, well, then, we'll continue to adjust. But, this is a seasonally weak time of year. Again, October's coming up. Sentiment is very bad. The bad news is very obvious in terms of rates. So I would just keep an open mind going forward. But right now, no question, I would be careful. In Cabot Growth Investors model portfolio, we've had more than 40% cash for weeks at this point. We're up to maybe low to mid 50s at this percent cash at this point. Could go higher. I'm not really anxious to be 80% cash. I mean, I'm never anxious to be 80% cash, but I'm not anxious to do that. But, let's see how it goes here in the next, week or 2 or 3 as the market kind of digests the Fed and higher interest rates and that sort of thing, okay? All right, let's hop into the charts. As usual, I'm using a program called MarketSmith. You can learn more at marketsmith.com. It's a product of Investors Business Daily. I think the big thing here is, again, we were kind of already in the correction, so I wouldn't say, I hesitate to say this week was a character change. I mean, maybe it was, but it just kind of was confirmation that the sort of bump we saw in late August, which had already kind of run into some trouble, is sort of over, and we'll see how it goes. But so here's the NASDAQ. We're clearly below, the 25 and 50-day moving averages. We're clearly above the longer-term 200-day line. And just, this is kind of what I meant by not kind of looking too far ahead. Right now the NASDAQ, which has been sort of the leading index this year, right? Obviously, it's kind of back down to its August low. Is that good? No. I mean, this action's pretty bad. But is it 2008? No. Is it 2022 at this point? No. It's kind of still in this corrective mode, okay? But there's no question the intermediate term trend is down. S&P 500, very, very similar chart, a little bit weaker, but again, just kind of back down to the August lows, which is bad, but not, 2008. Now, I will say, and I did write about this, this is the IWM. So this is Russell 2000 small caps. And let me blow up the chart a little bit, meaning, okay, a lot of the market, not just small caps, but even if you look at like unweighted big caps, the RSP and stuff like that, there was a bottom here in October of last year, and there was a nice rally to January of this year. Okay, and we actually had like one of the key blast off indicators flashed, and technically that's worked when you're looking at the big cap indexes. But really, a lot of the broad market has just been kind of carving out this long range here for month after month after month, where you do get a month or two on the upside, then you kind of get a month or two on the downside and all that. Okay, the IWM's the worst of it, but if you look at we look at these every week, but MDY, on a shorter or intermediate term basis, clearly below moving averages. But even on a weekly basis, again, here was that January high, never could really get going. This was the March banking crisis low. So we've just kind of been in this long, tedious range for a lot of the market. I mean, it's just perspective. I'm not saying this as predictive or anything like that, or, hey, we're going back down to the lows. That's not what I'm saying. It's just kind of good to understand sort of where a lot of the market is at, okay? In terms of the indicators, though, we're well below the 50-day line in the MDY, and even the New York Composite, which was kind of in the middle of all this stuff, right back down to the 200-day line and below the 50-day. So intermediate term trend is clearly down when you're looking at stuff like that. I think more important to me this week, honestly, than the major indexes was just there was a decent amount of stocks, and there still are. There's still a lot of stocks that are kind of setting up, quote, normally. They're not completely broken or whatever. But we had some of these stocks that were like extended leaders. They really have never broken. And now you're just seeing them unravel. Like this is ELF, just a huge run. Certainly, the fact that it broke here is kind of what you'd almost expect. But I mean, you're seeing stuff like that break. You're seeing Builder. This was Builder's First Source. Had this huge run, and now it's 22% off its high all of a sudden. Okay, stuff like that. And then we also started seeing kind of a return to the bad old days of selling on strength. So you try to kind of break out, even if it's a short-term breakout, boom. Okay, so this was IoT, which looked not perfect, but this was a classic sort of double bottom base, breakout on earnings. Market wasn't ready, so certainly could pull back some, but this is not a pullback. This is just a complete reset. Doesn't mean it's going down 10 points. I'm just saying now it needs to kind of build a whole new launching pad. Shopify, which isn't really my cup of tea, but it had obviously a pretty good recovery here, correction, but kind of came back, pretty good volume, and then boom, just all the way back to its lows. We're just seeing more of that. I don't know, there's probably another example in here. Oh, this was more shorter term, but we just noticed a couple, like last week, it was like, oh, Amazon, again, that's not my cup of tea, but Amazon, big liquid, keep an eye on it, actually hitting new highs here, even though the market, was still kind of futzing around, and, went from 145 to 130 in a handful of days, which for Amazon's a pretty big move, right? So, just a lot of that sort of thing. So clearly the sellers are in control here. I don't think I need to dig in on that. I'd mentioned the small cap stuff. I will say a couple of things. So growth stocks, kind of were off the August lows here. They were kind of, I don't want to say leading, but bouncing really well, forming some things. And I'm going to get to some stocks. They do look pretty good, or at least they're holding up pretty well. But this is like the ARK fund. It's just kind of, just like the rest of the market, it's kind of giving it up here. This is IPO, a little bit stronger, but again, basically right back to its lows. And I think probably more important than those sort of niche areas, this is the chip stocks. Again, I don't look at this and say longer term, it's a mess. But this was really the AI bump. We had a few more weeks up. And now the chip stocks, this is SMH, have just kind of formed this topping area. Now, I'm all for this being a shakeout and chip stocks soar from here, and I'm in. If that happens, I'm all in. But, at this point, just given the evidence right now, clearly the intermediate term trend is down, and, it's getting ragged, and it's back to levels kind of where it first took off here a few months ago. So just to show you that it's broadening out. I will say, and I know I mention this every week, it's not predictive, but I do find it interesting that this is the XLP. We're not seeing, I know there's recession and whatever, but recession talk and all this stuff and, all these things. But, we're not seeing a rush into like toilet paper and toothpaste. Okay. There's an ETF. This is very thinly traded, so I'm not recommending it. It's called POWA, POWA, but a lot of some of them are growth REITs or something, but they're kind of sturdy, non-cyclical companies. So they're not, I wouldn't say it's pure defense, but it's kind of more stodgy if you had to own some of these stocks. And this thing got crushed yesterday. So it's really just kind of across the board. I think it's a small positive, or at least not a negative, that the defensive stocks are getting hit too. I think that does mean that it's on the table. We're going to get a sustained advance from here. And actually, I think, if we get sentiment really down, it's going to be pretty powerful, but We just have to get through the storm first. Okay. So right now, the main message is, if you've been cautious, maybe be a little bit more cautious. If you haven't been cautious, don't stick your head in the sand, take some action. But for everybody, I wouldn't, assume bad things for the going forward. It could happen, but I'm just saying, let's just take it day to day and see how the market plays out here now that the Fed news is sort of out and everyone's sort of digesting it. Okay. In terms of individual stocks, it's a bit of a hodgepodge, but I have found some stocks at recent strength that are still holding up well. Okay. This is Fabrinet. It's not my favorite business model, right? It's just like a contract manufacturer. But FN, okay, it was in top 10 a few weeks ago. Let me change this back to this. Okay, so it looks a little bit more proper. But nice kind of, big deep base, big breakout on earnings. And you wouldn't notice, the things I like to look for right now are charts where you wouldn't know the market has kind of had some huge mayhem this week. You wouldn't know that a lot of these stocks, like ELF and stuff really cracked. You would just think it's kind of a quiet week. And here's the stock. It has pulled back here, but it's held the 25-day line, totally reasonable, looks pretty good. Elastic, ESTC. Now, Splunk, which I mentioned, I guess I'll put Splunk on there, it was in top 10 this week, so at least we had a winner. It's getting bought out by Cisco for cash and that sort of thing. So there's a little bit of overlap here, which might be one reason Elastic is holding up pretty well. But you're going to see on the weekly chart, big bottoming action, some tightness near the lows, the big earnings gap, and as opposed to, Amazon, IoT, whatever, Shopify, those sort of things, this is holding in there really well, clearly well above the moving averages. Would I chase it here? Maybe, maybe not. It's up to you, but just kind of flagging it. Certainly relative strength here, really challenging a new closing high today. I mean, that's pretty good in this environment. NTNX, NTNX. This is one of these cloud subscription software. I mean, Splunk was one of those. That's, stories that's kind of it takes a long time to mature, but once it does, like it's free cash flow and so on and so forth. Really nice long-term breakout here. It had this nice off the bottom run, and then that usually doesn't work forever. So then it builds this huge multi-month structure, breaks out. Yes, it's pulled back, but you can see on the daily chart and the weekly chart, holding the 25-day line. So NTNX is certainly a name that's pretty encouraging, and pretty encouraging to see some actual volume support here the last couple of days, not to get in the weeds. So it looks pretty good here. Duolingo, we'll see. This thing is so volatile. I think it moves around. I think I just did it. It was like 4 or 5% a day from high to low. So it's you can't have a real tight leash on it, especially in this environment. But this was kind of like IoT. It had this double bottom base. Of course, it tried to break out, but breakouts in this environment, no thanks. And it did get whacked yesterday, but it kind of closed off support. It's kind of, we'll see where it closes today, but you can see the weekly chart so far as of, 11:30 in the morning is, holding in there pretty well, held the 10-week line. So this one's still on my watch list. It's a great story, and it's kind of a non-tech story. It's not just networking, AI, cloud sort of thing. So kind of interesting. So Duolingo is still a name that I'm pretty high on, but, let's see. I mean, going from 165 to 145 in a couple of days is, it's hard to hang on to those. We are still seeing it's a mixed bag. So cybersecurity, I guess if you look at HACK, which is the ETF, HACK, it's kind of pulled back, but still normally to the 50-day line. The two that look best here, this is Zscaler. Again, it's pulled back here. It's not like it's immune to the pressure, but overall, I'm not looking at this last few months and saying anything abnormal is happening. No volume on the sell-off. CrowdStrike, CRWD, still above the 25-day line. They had some higher kind of long-term guidance, I guess I would call it, so to speak. So the stock's been acting pretty well this week. In fact, I think, it's down, it's down $1 on the week, which is pretty good given what's going on with growth stocks and the rest of the market. So there is some strength there in a pure growth sector like that. And then kind of a hodgepodge, like I said. This is Light & Wonder, which was the old, I forget, not International Game Technology. Was that it? I forget. But this is basically a gaming company, lotteries, systems, and slot machines and all that sort of thing. Not your fastest mover, but, just notice it's been in kind of a, I wouldn't say persistent, but a pretty steady advance. Now you're getting a pullback to the 50-day line. Whether you want to play it or how you want to play it is up to you, but it looks proper, especially if it can bounce off the line and look like a pullback resumption. I'm still intrigued that bull market stocks, so these are stocks that, their business is basically they own assets or alternative asset managers or whatever, and they're acting really well. Now, maybe the Fed in a weird way with higher rates is helping that, but this is Apollo, which is pretty big into fixed income. APO, this is the strongest one. You can see just almost at new highs right now. Blackstone's taken on a little bit of water, but overall, it kind of started to come to life. 50-day line, nice ramp, and then I think right now with so many stocks, again, it's not like growth stocks got hit in early August, but these two areas still look good, or whatever. Now it's kind of like 80% of the S&P 1500, so that's big, mid, and small caps, are below their 50-day line. So if you find something that's can hold up, and say the market goes down for a little bit longer, if it continues to hold up in this environment, unless it's like pure defense, like I said, toilet paper, it's probably a pretty good sign. So I find it encouraging that APO and BX are holding in there pretty well. Lee Auto is one. I mentioned it in Cabot Growth Investor this week. Just kind of a nice, I think this is a normal base building effort right here. Had a nice breakout and run. It's kind of sitting around its old highs. It's an electric vehicle play. Great growth. It is Chinese, which can be good or bad. Like today, it's kind of good. There's Chinese stocks are popping. But to me, overall, this just looks like 6 weeks or so, 7 weeks or so of a normal consolidation. Autoliv, it's actually a little bit of an EV parts play. It's not that sexy. Obviously, the chart isn't dynamic, but the growth looks pretty good. Okay, it's picking up steam in a big way this year and next. And overall, it's been choppy, but gapped on earnings here and kind of is sort of just hanging in here. So we'll see how that goes. VRT, this is Vertiv. This one, the good news is not, I want the market to go up, but the good news about when the market's kind of weak and everything is weak is sometimes it kind of gives you, a lot of times when I see a stock that's way up, like an ELF or whatever, I just kind of, to me it's a hold, definitely trail your stop. Hopefully it keeps running for month after month, but it's kind of like, I don't want to, if it's up 500% and it's just kind of kiting higher, I'm probably not going to chase it. So something like Vertiv, obviously it kind of broke out way back here, million weeks up in a row, gapped up again, acting great, had a secondary that absorbed, really acting great. But, as of 3-4 weeks ago, it's like, I don't know, like, what's to say this thing isn't going to get nailed like everything else? And it still could. But the fact that now we're starting to see the pressures really unleashed on the market and this is still holding up makes me like it a little bit more. We'll see how it goes. I'm not, again, we come in next week, maybe it gets nailed. But so far, VRT is definitely a kind of a rare bird in the sense that it's had a huge run. It's got huge growth. It's got the numbers, real earnings, real estimates, growing sponsorship, and is refusing to go down too much. It's 9% off its high in this type of environment. Same sort of thing with, not the same, but tangentially related is Array Technologies. I've mentioned this before where ARRY, solar stocks stink. And this stock is just, just look at the weekly chart. It's just been, boom, boom, boom. It's just been all over the place. Daily, it's all over the place. But now I'm looking at it saying, okay, let's see what happens. The stock is still kind of holding above its 25-day line here. I'm not going to say it's tight or anything, but it's still holding up pretty well while everything's getting killed, while the group is terrible. What if the group turns positive? What if the market gets going? So that's how I look at some of these things. So the longer that this can hold up generally well, I'm not saying it can't come down a little bit, but the longer these things can hold up, the more of a clue it can be, okay? And last but not, I guess I have a couple more. My notes were cut off here. YETI, this kind of, tried to get going. Again, there's resistance here. Tried to get going and didn't quite yet. $50 is kind of round number resistance. But again, hanging out the 25-day line, kind of a turnaround play. Earnings should go back up starting next year, really. 20% next year. So this is kind of one of those consumer plays that can trend, okay? Then just a couple of commodity names. CCJ, which is uranium, has been very hot and very strong. Usually you want to try to get these on dips. So we'll see what happens. But, if this thing can kind of chop in a little bit, that might be interesting. And then oil stocks have not been immune, so we'll see how it goes. But this is Diamondback Energy. The chart on MarketSmith doesn't adjust for dividends. So if you look at kind of a dividend adjusted chart, it is kind of more back. It kind of got up to its old highs and now is pulling back. Either way, it's kind of pulling back into the 50-day moving average. There has been some volume, but I guess I'm just saying I'm seeing some pullbacks in oil land that look, they're not pleasant, but they're not abnormal. So let's see how it goes. If these things can find support, of course, oil prices are still elevated. and the market doesn't implode and these things can kind of resume higher, you could have something to play with. So, I think, like I said, I'm just kind of keeping an open mind here. It's a seasonally weak period. Late September is. October tends to have some bottoms. I'm not a big seasonal guy. I'm not going to start using that as some excuse for the market at all. But, the bad news is out. Sentiment is very negative. We're already 2 years into this sort of sloppy mess for the broad market. And obviously we're 2.5 months into the correction, so to speak, or a little bit over 2 months. So let's just see how it goes. Right now, I do think it's definitely, if you're not cautious, if you don't have a lot of cash, or at least, whatever that means to you, I wouldn't, just hold and hope. I would do some selling and stuff like that, because partly because a lot of the stuff that I got stopped out of, or things that I might have bought but didn't buy, you look back from a month or 2 or 3 ago, and these things are much lower. So you don't want to assume they're going to come back. It's a good company, that sort of thing. But at the same time, let's just see how it goes a week or two from now. I do think how the market reacts from here, not necessarily from today on, but over the next few days, couple of weeks, now that the Fed news is out and so on and so forth, I think that will probably tell us a lot about the intermediate term trend going forward. Okay, that's all the time I have for today. As always, thanks for listening, and come by again next week for another Cabot Weekly Review.